Welcome to the channel, and in this video we're going to take a look at Fiverr, a high-growth company that is currently at a very interesting price point after the recent sell-off due to inflationary concerns and the pandemic coming to an end as more and more vaccines are being distributed. So let's jump right into it. Fiverr is an online marketplace for digital services. The company was founded in 2010 and is headquartered in Tel Aviv, Israel. Fiverr offers freelancers the opportunity to offer their services worldwide. Since the company's inception, more than 50 million services have been processed on the platform. Fiverr was founded by Misha Kaufman and Shai Wininger and launched in February of 2010. The founders came up with the concept of a marketplace that provides a two-sided platform for people to buy and sell a variety of digital services often offered by independent contractors. Services offered on the site include writing, translating, graphic design, editing, and programming. Fiverr services, which are called gigs, start off at $5 and can run into the thousands, depending on the time and expertise needed to complete them. The website launched in early 2010, and in 2012, it already hosted over 1.3 million gigs. Since then, the website's transaction volume has grown almost 700%, and it is now ranked among the 100 most popular sites in the United States and among the 200 most popular sites in the world. In June 2019, Fiverr was finally listed on the New York Stock Exchange, giving us investors the opportunity to buy and own a share of this promising company. Since the start of the pandemic, over 2 million Americans have taken up freelancing. This means that approximately 36% of the American workforce is now in the gig economy. Fiverr believes that this is not a temporary trend, however, but rather a shift from the traditional workplace to the future of work. Instead of long-term employment, people will try to build their experience. Instead of working from the office, people will be able to work from anywhere. Instead of local teams, we'll have global and remote teams. And finally, instead of working full-time to receive a monthly salary, people will get paid for action and results. Right now, freelancing is still an old-school business. According to the US Census Bureau, the online freelancing industry right now is just like the e-commerce industry in 1994. Freelancing activity is gradually shifting to the online world, but there's still a lot of room for growth. Fiverr generates revenue from fees for posting gigs on its marketplace. However, in recent years, it has expanded its revenue sources to include online courses and Fiverr Business, which caters specifically to companies' needs by allowing them to easily find high-quality freelancers that can work for them on a project-by-project basis. Furthermore, there are new added features on the actual platform that greatly improve customer experience. One example of this is the addition of the Fiverr's Choice label, which gives clients greater confidence when purchasing a gig. These measures, in conjunction with the current pandemic, have made Fiverr ever more popular. Its active user base has grown from just under 1.8 million active users in 2017 to 3.4 million active users in 2020. More importantly, Fiverr has been able to monetize its clients more effectively than ever before. While in 2017, the average spend per buyer per year was just under $120, in 2020, that number has jumped to $205 on an annualized basis. The cherry on the cake is that Fiverr has been able to achieve this without a sales force. Rather, thanks to the high value creation that Fiverr's freelancers are able to provide on most transactions, the organic network effects have simply worked in Fiverr's favor as they have driven a majority of new buyers to the platform. As you can expect from a growth company, Fiverr does not perform all too well when it comes to profitability and value. However, it has seen strong growth over the past years and is expected to grow even more in the future. Additionally, as a lightly leveraged company, Fiverr features strong financial health. Let's take a closer look at these metrics. As a young growth company, Fiverr has yet to turn a profit. Its current return on assets of negative 1.72% is below the industry average of 0.12%. Its profit margin of negative 7.81% is also worse than the rest of the industry average profit margin being negative 0.02%. However, if we look at Fiverr's Petrosky F-score, the company receives a healthy 6 points, indicating average health and profitability for Fiverr. The Petrosky F-score is a number between 0 and 9, which is used to assess the strength of a company's financial position. The score is used by financial advisors in order to find the best value stocks. It looks at a variety of factors such as companies' return on assets, operating cash flow, accruals, change in leverage, change in current ratio, etc. There's no doubt that rapidly growing companies don't provide the best value, and Fiverr is no exception to the rule. Fiverr stock currently trades for more than 40 times trailing 12-month sales, and its nearly $8 billion market cap valuation is greater than that of Upwork, another online freelancing platform, even though Upwork has hauled in more than double the revenue in the last year. Therefore, it is safe to say that Fiverr is not the best stock to pick up for value investors by traditional metrics. However, if one is to believe Cathie Wood, value investors might be in for a beating, as she recently tweeted, "The S&P 500 and the Nasdaq are populating their benchmarks increasingly with the value traps created by innovation, stocks that are cheap for a reason. Innovation is disintermediating and disrupting the biggest companies in traditional benchmarks." Fiverr is definitely one of those disruptive companies and should not be disregarded by value investors who are open to diversify their investing strategies. Growth is where Fiverr is really able to shine. The company shows a strong growth in earnings per share. In the last year, it has grown by 85.59%, and it is expected to grow by 91.49% on average over the next 2 years, which is quite impressive. Revenue growth is also strong. Revenue has been growing by 53.78% annually on average over the past 5 years, and in the last year, revenue grew by a mind-blowing 76.99%, greatly outperforming the industry. Fiverr's health is also strong. A current ratio of 4.05 indicates that Fiverr has no problem at all paying its short-term obligations. Also, when comparing the debt-to-equity ratio of 0.01 to an average industry debt-to-equity ratio of 0.18, Fiverr is way less dependent on financing than its industry peers. Furthermore, an Altman Z-score of 9.37 indicates that Fiverr is not even close to being in any danger of bankruptcy. There are 3 main risks to the future potential of Fiverr. First, as the current pandemic is coming to an end, many professionals may go back to carrying out their activities offline by meeting up with clients in person. This would also mean a reduction in demand, as more people seeking professional services would look elsewhere. Second, rising competition. LinkedIn just recently announced that it is currently working on the development of a freelancer marketplace. Companies could use this to find suitable freelancers, connect with them, and even pay them via the platform. It might be a big challenge for LinkedIn to compete against already established marketplaces like Fiverr or Upwork, but the network already has a lot of users which can be cross-sold on the new platform. If LinkedIn manages to guarantee good quality on the freelancer marketplace and to easily implement contact and payment, this could mean serious trouble for Fiverr. Third, Fiverr needs to become profitable fast. Investors were expecting Fiverr to break even in the last quarter. Unfortunately, Fiverr was not able to deliver on their expectations, bringing in a GAAP net loss of $8.1 million. If Fiverr continues to underperform in this regard, investors may look to put their money elsewhere, which could entail a drop in the stock price. Fiverr has massive upside potential. A huge untapped market, impressive revenue growth, and a solid business model all speak for themselves. However, competition is strong and is likely to increase over time as more and more companies want a piece of the action. If we take a look at what analysts say, the bullish case for Fiverr becomes more apparent as it currently holds a buy rating of 2.1 and an average price target of $309, indicating a good buying opportunity right now. This brings us to the question, what am I going to do? I believe that right now Fiverr is at a great buying point after the 24% drop following the February all-time highs. So I'll be looking to add some more shares to my portfolio in the coming days. Let me know in the comments what you guys will do. Until next time.